Today's meeting includes Paul Merriman talking about the ultimate buy and hold strategy, and our second speaker, Chris Pedersen, will talk about 2 funds for life, pre and post-retirement.
Paul he's just been in the industry for a long time, very experienced money manager. And it's a real treat because he's now on the second chapter of his life, and he's actually dedicating his work right now primarily working with younger folks, he tells me, and folks from the FIRE movement. But he's a nationally recognized expert on personal finance, mutual funds, index, buy and hold, and asset allocation. He's the founder of Merriman. They're an investment advisory firm managing over $1.6 billion. That's a large firm. And the other thing about Paul is, everything he's accomplished, as I engage with him, he's such a gracious spirit. I mean, just really humble. And so I really admire and appreciate that. So as I said, he's working on just educating investors, particularly younger folks. He's the author of 7 books, including This Financial Fitness Forever and Living It Up Without Outliving Your Money. He's also a regular columnist in Retirement Mentors of MarketWatch.com, has a podcast at Merriman.com, and you can go to his website. There's a bunch of different articles on asset class selection, asset allocation, mutual fund, and exchange-traded funds. And then he also is involved with his foundation. And then the second person I'd like to introduce is Chris Pedersen. Chris is, I would say, Paul's protege, and Chris has a background in engineering, but now full-time working with Paul on the investment side of it. So he's been a lifelong buy and hold investor, but then I know you have your own twist on it, applying some of your technical engineering skills to that investment strategy. So we're really looking forward to hearing both of you guys present, and thank you for joining us.
All right, so let me share with you some information about investing today that has to do with a huge change of focus in my investing involvement. When I was an investment advisor, my job was to take care of people, and we had advisors who take care of people with all of their financial decisions. But when I started the Financial Education Foundation in 2012, after I had sold my firm, I started to focus on education very narrowly, because I can't be an investment advisor to people anymore. But what I can do is to try to share with them what I think are the primary, most important things they should know about investing, whether it's the college student just about to go out to work, or whether it's pre-retiree or even retirees. And you'll see some of the work for each of those groups as I move through the presentation today. But I now focus on, in fact, I'm writing a book right now along with Rich Buck, who's worked with me for about 30 years, on the 12 most important investment decisions, each one of them literally $1 million decision. And we also work a lot on distributions, and I'll cover what I think are 3 of the most difficult decisions we have to make. Some of these are so easy, but some are more difficult. I love quotes. I love financial quotes. I'm working on a list of my favorite 200, but Warren Buffett easily is the winner in terms of number of quotes. And the quote that we all know from Warren Buffett is rule number 1, never lose money. Rule number 2, never forget rule number 1. Well, it is obvious, knowing what we do about Warren Buffett, is that never losing money didn't have anything to do with the short term. I don't think he was ever worried about a bear market. He was worried about an investment that was good for, in essence, a lifetime. And so as we think about the mistakes that we might make, and a lot of Warren Buffett's quotes are not just about the right thing to do, but they're also about the things you should not be doing, the mistakes. And another quote that he has that I like, because so many parents will tell me, I think they should learn how to do this themselves. They should learn mistakes on their own. Buffett, I think, disagrees. He says it's good to learn from other people's mistakes, but it's good to learn mistakes on your own, but it's better to learn from other people's mistakes. And I think that's right. And that's what I'm trying to do, is to show young people those things that they should be doing and not have to lose years of compounding because they make those typical early mistakes. But my favorite Buffett quote, and this is about Buffett addressing success: you only have to do a very few things right in your life, so long as you don't do too many things wrong. Again, it is focusing on what is right, and there aren't very many, but I think it's important to equally balance that between understanding what the things are that would be wrong. So here's my goal today. I want to focus on solving a few decisions that I want to make sure that they are the good decisions, and I want you to make fewer bad decisions. That's my goal for any investor that's willing to sit and listen to me. Now, I am not worried about a bear market, just as Warren Buffett is not worried about a bear market. Both Peter Lynch and Warren Buffett have said, if you're not willing to lose half of your money, then you shouldn't own stocks. And so we know they expect, both of them, that along the way we have to go through these bear markets. But you see, you can also, other than just simply exposing yourself to equities and losing half of your money temporarily, because bear markets have always been temporary, almost all of them, but bad decisions lead to permanent bear markets. And what I call a permanent bear market is that at the end of your career, you have left serious money on the table. And I'm going to use as kind of the dividing line that if you leave 20% on the table, you have just permanently experienced a terrible bear market. And I feel if you make good decisions, you are going to eliminate the permanent losses. That's my goal. Okay, let's assume we have two investors. One investor invests $6,000 a year for 40 years and gets an 8% compound rate of return. That's during the accumulation period. Let's assume that during the distribution period for the next 30 years of their life, that they take out 4% a year and they earn 6%. Now, what are the implications of being able to make an extra 0.5% during the accumulation period? What are the implications of being able to earn an extra 0.5% during the distribution period? Because that 0.5% turns out is almost exactly that 20% decline that we're worried about. So here's the impact over the period of time, over 40 years, putting away $6,000 a year. It grows to $1.678 million. If you made 8.5%, it grows to $1.9 million. Then you start living off that money. And during that 30-year period, based on the 6% return, you take out about $2.6 million. If you made 6.5%, you're going to take out about $3.2 million. Now that's kind of step one is to retire. Step two is to live off of that money. Step three is to make as many people happy after you passed on as possible. And that has to do with what you have left over. And so at the end of that period of time, at the 6.5% return, you end up with 2.8 million. At 6.5%, you end up with 3.7 million. So the real return on our investments is how much money we take out of them in retirement and how much we leave to others. In the case of investor one, it was $5.4 million between the two. In the case of scenario two, number two is almost $7 million. That difference is $1.5 million. So my challenge to young investors is let's find every way we can that we can legitimately hope to add 0.5% and change our financial future. But it turns out, as you'll see in a few minutes, that even at retirement, the ability to make an extra 0.5% can turn into millions of dollars. So where are the easy, low-hanging fruit? How can we pick off these kinds of 0.5% mistakes? Where can we find 0.5%? Well, one is, as you know, load versus no load. You know, if you buy a no-load fund, literally an equity fund, a no-load fund where you might give up a 5% commission for, in essence, the rest of your investing career, that in and of itself is enough to add 0.5% to your return. Lower expenses. A lot of people are still paying 1%, 0.75% to own a mutual fund. Well, we know right now you can buy mutual funds at Fidelity where there is no operating expense. Or you can pay as much as 0.1% and get a mutual fund that has as good an expected return, in fact, better than the one charging 0.75%. You can buy mutual funds that have lower turnover. According to John Bogle, if you buy and sell the portfolio, you have 100% turnover in 1 year, that costs you about 1%. Lower taxes. Well, we know if we invest in a smart way that it's easy after taxes to make an extra 0.5%. And the other one that a lot of young people certainly don't know is that every 10% of equities that you add to your portfolio, historically, compared to owning bonds, historically adds about 0.5% to the return. And the one that I love, because it's a relatively recent one actually from the academic community, and that is that the evidence is that the wider, the greater, the more massive your diversification is, the higher the expected return, not the lower expected return. So today I want to focus on 3 major decisions. Which equity asset classes do we have in our portfolio? How much equity and how much fixed income in our portfolio? And our choice of how we take distributions. And if we can get those 3 right, I think it is easy. It is easy to be able to add huge returns over a lifetime. I want to talk about the equity decision first. Here's a table that compares the return of 4 major U.S. equity asset classes. Large cap blend, which could be the S&P 500. And by the way, the total market index has virtually the same compound rate of return as the S&P 500 over 92 years of evidence. And then there's large cap value. Now, a large cap blend is a blend of growth and value. Large cap value means you try to eliminate the growth and you position on companies that are considered to be, for some reason, out of favor. And then we have small cap blend and small cap value. By the way, these big companies here, they could be $50 to $100 billion and more. These smaller companies are anywhere from 2 to maybe $3.5 billion. So there's a huge difference in those asset classes. What do we know about the returns of those 4 since 1928? We know the S&P has earned 9.9%, the large cap value 11.1, small cap blend 12, and small cap value 13.2. Well, we know that most people have their money in the large cap blend. And That is partly because those are companies they know, but it's partly because they're considered to be less risky, and they are, particularly one company at a time. And here is the range of return over that 92-year period. There was a calendar year it was up 54%. There was a calendar year it was down 43.3. Large value up 92.5, down 61.1. Small cap blend up 111, down 48.3, and small cap value up 125 and a minus 55.5. So it's no secret that there's more risk in these other asset classes. I would like to see in a portfolio people going beyond a large cap blend. If you look at the typical target date fund, you're going to see that large cap blend, whether it's US or international, overwhelms the portfolio. But look at this, what I call the 4-fund combo. 25% each of those 4 asset classes over that same 92-year period, 11.8%, almost a 2% difference. And the best year was up 96 and the worst year was down 51. Now, when somebody asks me, what do I expect the market to do next year? And the market they're normally talking about is the S&P 500. I have kind of 2 answers I can give. One is, well, I think it'll make about 10%. And that is often what experts will pick as the expected rate of return in the following year. Or I could say, well, I think it'll be somewhere between a gain of 54 and a loss of 43. Because when we look at it 1 year at a time, we can see that has happened in the past. Well, we know we're not investing for 1 year. We're investing for a lifetime. When somebody asks me, how have you done with your investments? The real true answer, I mean, what really counts as far as I'm concerned, you'll have to wait until I've passed away. You've got to wait till I'm dead to find out how I did, because my investments are positioned not for today, but basically for a lifetime. And Chris Pedersen will be talking about a strategy for a lifetime that I think you'll find very interesting. But what about when we extend that period of time? What about when we look out 15 years instead of 1 year at a time? We look at every of the 77 15-year periods between 1928 and 2019. Notice how the best and worst times narrow. Instead of being up 54 and down 43, the best was up 18.9 and the worst was a little better than the break even. The average 15 years was 10.7. It narrows for every one of these asset classes, 21 to a minus 0.6, 23 to 1.6 up, 26 up, and minus 1.9. Very similar returns in the worst case and all great returns in the best. But look at the averages, 15.8 for small cap value, down to 10.7 for large cap blend. If I'm looking for additional returns without crazy risk, and of course we all have the different ideas of what crazy might be, but for my wife and myself, we are actually half in small cap and we are half in large cap. And later I'll show you why we are also in the equity part of our portfolio, half in US and half in international. But look at this 4-fund combo over here. The compound rate of return, the average 15-year compound rate of return was 13.4. And if I look at the worst performance over 15 years, it was the same, 0.6, as the S&P 500. But let's look out for the real period we should be talking about, and that is the rest of our life. And I'm certainly not counting on 40 years. But I think looking at a 40-year projection, particularly for young investors, or even those that are in their 40s or their 50s, 40 years is probably a legitimate period of time. So we looked at all 52. By the way, the man, I know he's watching this right now, Daryl Balls, is our is a retired systems analyst from Boeing, a manager at Boeing. And I am so happy to have Daryl joining Chris and giving me all this help in producing all these interesting historical numbers. Large cap blend over 40 years. The average compound rate of return was 11. Large cap value, 13.5. Small cap blend, 13.8. Small cap value, 16.2. The 4 fund combo, 13.8. So that is greater than a 2% a year expected rate of return than the S&P 500. Now, I don't know what the future returns will be of the S&P 500 or any of these asset classes. What I do believe is, and the academics do believe, is that equities will give a premium over bonds. And that within the equity groups, that small cap will do better than large over long periods of time, that value will do better than growth over long periods of time. And that's the history that we have to look at. What the future will bring, we can either make it up, pretend we know what's going to happen, or admit we don't know, but diversify to try to take advantage of whatever asset classes are going to take us home in terms of returns. And you can also look down here at the best and worst of times. Notice the best 40-year period for the S&P 500, 12.5, the worst, 8.9. For the 4 fund, 15.9 for the best, 10.8 for the worst. The beautiful thing is, wherever you put your money for 40 years in the equities market, as long as you are properly diversified, it looks like the return should be pretty good. When I was an investment advisor, this table was one of the most important tables. Now, you all were sent a PDF that you could print out. You can, if you have that printout, look at the entire page of numbers. But here's what I know, that looking out over this entire period of time, in this particular case, you're looking here at 1970 through 1989. I'll show you the latter numbers in just a second. But in this table, what you see is how different combinations from 10% bonds, 100% bonds to 10% equity, 20% equity, 30% equity, 40 and 50. And you can see as you go out, you go to 100% equity. And we can tell not only over this 50-year period how this asset class, the S&P 500, large cap blend, we can tell how it did 1 year at a time. And most of us, like my wife and myself, we are 50-50 stocks and bonds. That's our asset allocation. We're not 50-50 with the S&P 500 because we believe in owning a lot of different asset classes. But you can see that with the 50-50, that the losses, and let's focus in on 73 and 74, the losses were not bad. Down 53, 5.3 and down 10.4 versus with the S&P 500, down 14.7 and 28.5. And I think it's important that people who are considering an investment know just as much about the downside as they do the upside. I have, for all of the time that I ran that investment advisory firm, and I still say this, if you follow my advice, I absolutely guarantee you will lose money. My goal is to try to show people how much money they're likely to lose depending on their balance of equity and fixed income. And here we are looking at the bottom of that page. And you can see there what happened in 2000 through 2002. It was a bloodbath for the S&P 500, down over 50%. And if you were in a 50-50 situation, you actually made a little money one of those 3 years. But again, the losses were muted. And that's important, as we know in retirement, to mute and minimize those losses. The most important part of this table is right down here at the bottom. See, I can't tell you what the gains are going to be. I will tell you that I think for planning purposes Just like we should live to be 100, we should expect the returns to be probably 2% less per year than they were the last 50 years, just for planning purposes. But the losses, I think you should expect the losses to be just as bad as they were. And I know from looking backwards that there was a 12-month period, not a calendar year, a 12-month period, you would have been down 23.2% with this combination of half bonds and half stocks, with the stocks being the S&P 500. There was a drawdown of almost 26%, which means from a peak to a valley before it turns around and moves on back up to that peak. And you can also see the drawdown with the S&P 500 all in stocks was a loss of 51%. Interesting that Warren Buffett and Peter Lynch should say, if you're not willing to lose half of your money, you shouldn't be in stocks. I have, for the last 20 plus years, been teaching people about what I call the ultimate buy and hold portfolio. This is the equity part of whatever you're going to own in equities. This is what I call the ultimate buy and hold strategy. And it's only, in essence, an ultimate for me. My wish for every investor is you find your own ultimate buy and hold strategy, which is hopefully what you own right now. But my goal was this: if more diversification is better, how should we do that? How would we build a portfolio to think we've got the best that we can be? Well, I know the best I can be is put it all in small cap value. We just saw that in that earlier table. But that's not a prudent thing for people to do, particularly as we get close to or in retirement. So and by the way, I did not come up with this idea for a presentation. I learned about this presentation in the mid-90s because it's what I learned from the people at DFA Advisors. And I thought it was easy to see the implications by taking baby steps. Change the portfolio one baby step at a time. You can see down here at the bottom of this page, portfolios 1 through portfolio 8. Portfolio 1 is 100% S&P 500. A great return, 10.6% from 1970 to 2019. $100,000 invested in 1970, no distributions, no added investments, grew to be worth over $15 million. The magic of compounding. Tremendous return. But if you had simply taken 10% of the portfolio and committed it to large cap value as a standalone asset class, the return inches up to 10.8. Now, inches doesn't mean a little bit more money. It means a lot more money. It means an extra 1.5 million over that 50-year period. And if you took a 10% position in small cap blend, plus the 10 in large cap value, plus leaving 80% in the S&P 500, it inches up again to 11% and turning that original 100,000 to 18 million. Then if you add what is historically the best of these asset classes in terms of return, if you added 10% in small cap value, it bumps it up another 0.3%. Now got a $21.6 million pot of gold. Now the next asset class, U.S. REITs, and this would be for a tax-deferred account because you've got REITs in here, but REITs have about the same return as the S&P 500. The reason they're here is because while they have the same return, they don't go up and down at the same time. They're relatively non-correlated, and that adds another 0.1%. Am I interested in an extra 0.1%? Sure. I mean, it doesn't add $1 million, but it adds enough to sweeten the pot when you're gone. But now you are up to 22.3. Now, in one fell swoop, I'm going to go from 11.4 to 12. Now that looks like a huge jump. It is, but that jump comes because I've added 10% in international large cap blend, 10% international large cap value, 10% international small cap blend, and small cap value. And you will notice here that now that compound rate of return is 12%. And over that period of time, you have added about almost $14 million. And then you can add even one more. If you want to get more aggressive with your portfolio, you can add emerging markets. The point is, I call this the ultimate buy and hold portfolio, not because it represents how I can maximize my returns. It does not represent how I can maximize my returns. If I want to maximize my returns, there's one thing I could do. I could just simply get rid of the S&P 500 and the international large cap blend. That would provide a much higher return. But for me, I call it the ultimate because it says, okay, these are all good asset classes. I don't know whether they're all going to look in the future like they looked in the past, but I do believe they will all produce a premium. And so I would like to have, in fact, in our portfolios that my wife and I hold, where we have in the equity part, which is 50% of the buy and hold portion of our portfolio is equity, we have over 12,000 different companies, and they represent these different asset classes. So let's take a look at the implications of owning the worldwide equity strategy with the big, small, value growth, U.S. international, REITs, and emerging markets. How would you have done over that particular 1970 to 2019 period? How would you have done compared to the S&P 500? And you can see that if you see the far right hand, the two columns, you will notice 1 year at a time the difference between these two strategies. And the bottom line is, because you got about 2% better rate of return with the worldwide equity, it means that you would find down at the bottom of that page, you would find that the compound rate of return was, instead of 10.6, based on rounding here and based on including management fees, about 12.5. Now, as I look at the 50-50 strategy, the compound rate of return there is 10 versus it was 9 with the S&P 500 as the equity choice. And the losses, well, they're terrible. I mean, they're terrible, but they're about the same as the S&P 500. The worst 12 months for the worldwide was a loss of 50.6 versus for the S&P 500, 43.3. The worst drawdown was 58 versus 50.9. Now, I want you to notice here, I want you to notice the difference here just between a 40, 60, and 10% that you would get at 50-50. Remember I said that if you add 10% equity, it could increase the return by 0.5%. Here we increase it by another 0.5%, going to 60-40. In a few minutes, you're going to see the impact on that in terms of distributions. Now, I know one of the reasons I've always liked talking to AAII chapters is because I think most of them enjoy numbers as much as I do. And I have got over 50 tables on our website. I shouldn't say I have got, we have got over 50 tables showing different kinds of equity asset classes and showing the implications of investing and living off of that money from 1970 through 2019. And by the way, you will notice here with 100% in bonds, using the same returns that you saw over those 50 years on both. And this is, by the way, the equity portion of this portfolio is going to be in the S&P 500. But an all bond portfolio, starting out with a $1 million investment, taking out $40,000 a year, upping each year by inflation the amount that you take out. In other words, you start out by taking 40,000, the next year you take 42, then you take 43, then you take 45. The reason for those increased distributions is because you were adjusting the amount of money you take out by inflation. And it is interesting to note that at the end of 50 years, if you live that long, in order to do the same thing in 2019 that you were able to buy with money in 1970, it takes $266,000. Young people don't know bad things that inflation can do to you over time. And a lot of young people, 30% of millennials who are investing in their 401k plans are not willing to have any equities in their portfolio. So they have been, it has been found. Here's the 50-50 strategy. Notice what happens. At some point, because the market went south on you, you actually fall below the $1 million you put in. That, of course, makes people start to worry. On the other hand, think how people felt if they were 100% equity. 100% equity, S&P 500 would have been down at the end of 1974, would have been down to $718,000. I worked with a lot of couples when I was an advisor. I don't think I ever met one that both people would be willing to suffer that kind of pain and still stay the course. So I'm guessing that most people would no longer have that commitment to all equities, but I would say it's possible that the person who had 50-50 stocks and bonds would still be in the hunt. But for those who stayed the course and you go all the way to the bottom, $2.7 million left over. If you were 60-40, let's look at 40-60, $1.2 million. And as you can see by this white space, you can also run out of money, but 1.2 left for your heirs, 2.7. If you don't think you're going to live for 50 years, you could look at 20 years. You could look at 30 years. In fact, you could just look at various 10-year periods. How did it do from 1990 to 1989, 1980 to 1989, or 1990 to 1999? You can look at these various periods and see generally how you would have done. And this is using that famous 4% distribution that we've read so much about. I'm going to show you 5 in just a few minutes. But this is using what we call a fixed distribution. And typically people who retire with just enough, no extra, just enough. They can't wait to get off the job and retire. And they want to know, how soon can I retire and have enough? And so it assumes that that enough gives you the 4% with the inflation adjustment. But what if you had more than enough? What if you saved twice as much as you needed? What are the implications in terms of distributions? Well, one thing you could do, you could still use a 4% distribution rate, but look what happens if you take every year. In fact, the first week of each year, my wife and I take our distribution for that year, the first week of 2020, because I can't stand watching the market go up and down and count on taking a check out every week the way I would like to know I'm going to have it for the year. So my wife and I have chosen to take that year's income out the first day of the year. And I have done that with this table. Yes, you would have more money. Yes, you would have more money if you took it out monthly. But we have chosen just to do it in a very conservative way. But instead of taking out 4% and upping the ante every year by inflation, we take 4% of the previous year's balance. So the first year you start with $1 million, you take out 40,000. This is the 50-50 strategy. At the end of the first year, it was worth $1,053,000. You take 4% of that and you take out 42,122. And you just keep doing that all the way through until down here at the bottom, you've got how much you took out over that 50-year period. You took out $9 million and you were left with about almost $9.8 million. Now that's a lot more money than you ended up previously. Remember, you ended up, with 40%, you ended up with about 1.2 million. With 50%, you ended up with 2.7 million. And yet you ended up taking out more money than you would have taken out had you used that fixed distribution strategy. Now that is the good news. There is bad news. The great payoff comes later in life. At a point you may not choose to want to spend a lot of money. But this is a distribution strategy specifically for people who have oversaved. And let me show you how that works. I kept working until I was 70. My wife and I loved what I was doing. I still, in fact, I was teaching then as I'm teaching now, basically. But I wanted to make sure that we had at least twice as much as we needed, so that what we could do is we could take out a percentage and have more money than we need, money to give away to others, family, or to nonprofits that we care about, and maybe to travel a little more than we would have had we just had enough. So instead of $1 million, maybe you retire with $2 million. Now, if your need is really 40,000, you don't have to worry about inflation anymore. And in fact, not only do you not have to worry about inflation, you can do basically, you can take out more money. And I'll show you that in just a second. Take out a higher percentage. But first, let me show you those same tables using fixed distributions, but with worldwide equity instead of the S&P 500. The first thing I want you to notice that the 50-50 and 40-60 end up with a lot more money. I mean, it's a lot more money. 20 million instead of 1.2, 31 million instead of 2.7 million. Now, you can call me crazy, but the craziness only comes from looking backward. I am not suggesting for a second that that's going to happen. But I can say, because I believe adding those other asset classes, that each are individually more risky. This is not a free ride. You are, in fact, taking more risk, but because those asset classes don't go up and down together, sometimes they do, a lot of the times they don't, then the volatility is very similar. So you can see here with a $40,000 distribution that you're just fine. You still have a little problem here, but I'm guessing that most people, in fact, I always encourage people, even if they wanted to be all fixed income, please let me put 20% in equity for you. And the flexible distribution strategy using the worldwide equity with the 4% flexible. So there's that 4% of at 40,000. And by the way, it goes down here to 39,815 with the 50-50. And at the bottom of the page, you got your kids have more money than they need. You probably receive more money than you need. And you did that because you took more risk, but you did it in a prudent way, and you took a nominal amount of money out. Well, what happens if we decide to get aggressive? What happens if we decide with the fixed distribution schedule to take out an extra $10,000 to enjoy life more and call that our new need? We really need this. $50,000 on $1 million. Can you make that happen, Paul? Well, I will tell you that it's a risky business. Maybe for 10 or 20 years, you're okay. But if you come upon the wrong kind of market, a market in decline at the same time as you're taking higher payouts every year because of inflation, this is what can happen to your money. You can be flat broke. You can run out of money, or you can move in with your kids, or there's a whole bunch of things, or you just adjust your lifestyle somewhere up in here when you can see the writing on the wall that you've made a big mistake. You can cut back to taking $30,000 a year instead of 50. But being too aggressive with a fixed distribution schedule is really risky business. But look at here. This is what my wife and I are living on. We take out 5% the first of each year, and we do it on a flexible basis. I am the saver. I am Mr. Frugal. I wore the same tie for about 20 years. In fact, when I retired, the last workshop I was giving as a working stiff for the management company, they came up at the break and they cut my tie off and said, no more. And it feels so good, by the way, no more. So flexible. Flexible means that I get help. I, the frugal guy, the guy who doesn't like losses. I'm insecure about losses. I feel a little chaotic in a period like this. And so I try to be really frugal in times like this. But I'm married to this wonderful lady who believes that all that money we saved and that I worked longer than I needed to put away so that we could do more things. She rightly says, isn't that money for spending? And so what we've agreed, and I had many clients who made this agreement too, couples, that by going to the flexible strategy, when the market is in decline, it reduces our income. But it also protects us from spending too much money during a period when that decline may go on way longer than we expect. And on the good side is that I told my wife, from everything I know about history, 2 out of 3 years the market goes up. You're going to get a raise. You're going to be able to spend more money 2 out of 3 years. I am going to have peace of mind about 1 out of 3. And sometimes those 1 out of 3 happen 3 years in a row, like they did in 2000, 2001, and 2002. But by going to the 5% flexible, it forces you to cut back, and you did. You started at 50,000 and you cut back to 44,000 by 1975's distribution. But that's okay because we saved twice as much as we needed, so we were taking actually out about 88,000. And then the market turns around and it heads up, and by the time all of these years distributions, and they're nice distributions, I'm just not going to be able to live this long. But the ending value here, well, the total distributions, 8.1. Now, that's not so different from the 4% distribution schedule, but it front loaded earlier on spending the money and having more to spend. That's the good news. And the bad news is the kids don't get to inherit as much. But remember before, with the 5% fixed, it was cut off right about number 1994. You're dead broke. Here you've got 3.1, you've got 3.3. Flexible distribution. And here is the moderate worldwide. That last one, by the way, that was the S&P 500. That was not the worldwide. That was the S&P 500, the same S&P 500 that went broke. But now as we look at the worldwide, taking 50,000 out on a fixed basis, more of the columns get to the bottom of the page. But there's still a lot of white space here. And of course, it does well over that entire 50-year period. And you end up having taken out, when you use the worldwide, you take out about 12.9 million, and you're left with about 9 million for the kids, children, and charities. So I think, and remember earlier I said that even 0.5% can be $1 million decision in retirement, because you might even see here the difference between, let's just take the first 30 years with 40%. You end up with 5.6 left over, as opposed to 6.7 left over at the 50% versus 40% equity position. That extra 0.5% can add an extra $1 million to what you have to spend and you have to lend. Now I want to talk about the 4-fund combo for a few minutes. I don't have all the tables that you see here. I just don't have the time. But what I do have is at least the fine-tuning tables, so that if you wish to compare the 4-fund combo to the worldwide strategy, that you can. You'll be able to compare the really bad times, 73, 74. You'll be able to compare the 2000 through 2002 and the 2008. And what you're going to see with the 4-fund combo, and remember the 4-fund combo, that's S&P 500, large cap value, small cap blend, small cap value, and 0 international, 0. And you can see as you go to the page that reflects not just the bottom line compound rate of return. Oh, by the way, there, right, let's see, there's 100. I'm guessing that is the, bear with me for a second here. 2, 3, 4, 5, 6 over. 1, 2, 3, 4, 5, there it is, 10%, wanted to make sure. 10% was the compound rate of return of the 4-fund combo, along with half the money being in in bonds. That was the same return, I believe, that we had with the worldwide strategy. And the risk characteristics are very similar. And why are they so similar? Because the magic, the real magic, isn't in US and international. The real magic is the asset class, small blend, small value, whether it's US or international, large blend, large value, US and international. So that what you don't get is, you don't get currency diversification. There are some people who believe that the US may not always be number 1 in the world. That maybe China will be number 1 in the world economically. And that maybe other markets will somehow outperform us because they take a different direction in the way they build their economy. And that it makes sense to diversify across the globe. And in fact, the academics will tell you, many of them, that you should never have more than half of your money in any one market. US, for example. And think about the people, talk about a permanent bear market. Can't say that it's permanent, but the people who held all of their money in Japanese securities in 1990 are still waiting to break even. Hopefully, they were young people who dollar cost averaged into that economy. They did okay. But the risk factors are very similar for the worldwide strategy, as the returns are very similar. About 12.3 here versus 12.5 or 12.6. Several months ago, Daryl Balls helped us out to build a table that I just think it has at least a dozen great stories on it. Good one to show young investors, I think. Give them a sense of how things move around. And on this table, we have the decades starting in 1930 to 39. And how did long-term government bonds do? How did T-bills do? How did small cap blend, S&P 500, small cap value, and large cap value do? And there's the winner, long-term government funds or bonds. And here is the four-fund combo. Not number one. In fact, a four-fund combo will never be number one because it's made up of some asset class that will be number one. But look at the next 4 decades, small cap value, small cap value, small cap value. Look at 19.9, 19.6, 14.3, 14.2. To be fair, that was a period of time that people didn't recognize the implications of small cap value. In fact, there were managers individually that may have discovered this, and they had returns that people couldn't understand. How come they're making so much more money? It was because of value orientation. But you can see in every decade, large cap value pops up for 80 to 89. Then the S&P 500 pops up as number one. Small cap value again, S&P 500 again. It's easy for people right now to be saying that the S&P 500 is better than small cap value because we all have a recency bias. But what do we trust? The last 10 years? Do we trust the last 90 years? But let me show you a comparison of 2 things I would like to believe we could both trust. That is the S&P 500 without all the other noise around it, and the 4-fund combo. Here is why I actually believe that the 4-fund combo is less risky than the S&P 500 over longer periods of time. This, of course, are 10-year periods. Notice down here at the bottom, close to the bottom, further away from the bottom, but a lot of time closer to the bottom than to the top. 4 funds, close to the bottom, but then in every other year, decade, you'll notice the 4-fund combo is in there. I mean, they're never going to be number one, as I said before, but the volatility in decades is lower than the volatility with the S&P 500. And I don't know how to print money, but I do think that young people who will pay attention to this, and Chris is going to take them even a step closer, I think, to something that can be done in their best interest. But if they have the willingness to fool with 4 different funds in the equity part of their portfolio, I think this 4-fund combo could be a big winner. And because Chris is going to spend some time talking about small cap value, I want to share my favorite small cap value table. Because this is the U.S. small cap value from 1970 through 2019, as tracked by an index built by Dimensional Funds. I use this with young investors, willing to think they could, when they get out of college, yes, they'll be able to invest $1,000 a year. And here they can see how they would have done if they had invested $1,000 a year and every year up the ante by 3%, whether in the small cap value investment class, asset class, or the S&P 500 large cap blend. because they're adding money early on, and any bad stuff that happened is overruled by the new money. The new money makes it look like you're still doing okay. It's the old money that's taken the beating. So there are very few years in this 50-year period that you had less money in the portfolio than you had the year before. Just a handful. It is 50 years possible for an 18-year-old who's got a parent or a grandparent who would love to see them get started early. Got my attention. And that's something that many of us right now could help build and get them saving early and helping them do that. I hope you will all become familiar with paulmerriman.com. And where I want you to become very familiar is the best advice link here. You can find all of these tables, over 50 tables, fine-tuning, distributions, ultimate buy and hold tables. And you can also find on our website free books, for first-time investors, to people who have got a lot of money and are thinking about letting somebody else do it for them. Be sure and read Get Smart or Get Screwed. How to select the best and get the most out of your investment advisor. And we have over 500 podcasts and articles on our website. And we have portfolios at Fidelity, T. Rowe Price, and Vanguard, and Schwab. So, and if you do sign up for our free newsletter, our new book that talks about the 2 funds for life and the $12 million decisions, all of our newsletter subscribers will automatically be emailed a free copy, e-copy of that book. So with that, I think I've got a few minutes, Chris, and I think hopefully you've been making a list of questions that people have been asking.
I have. Let me turn my camera back on. Yeah, so there are a couple that came in at the very end, but let me go back to Richard asked 2 questions about Roth IRA conversions and another one about RMD distribution factors. So let's hit those first, and then there's a couple others. So
now, let me just interject, Chris.
Yeah.
I don't like to be a spoil sport here. I have an answer for every question. But quite honestly, when we get into Roth conversions and anything of any consequence at all, I typically refer them to Jim Lange's, Lange's website, a fellow that spends his life buried in that topic. So now, if you want to ask me the question, because I've got an answer for everyone, I'd rather not.
No, that's okay. I think that answers his first question, which is, have you considered IRA to Roth conversion strategies? And I think the answer is go talk to Jim or read his work. It's not something you or I have spent much time on. The second question, what's that?
I can tell you what I've done.
Sure.
What I've done is I have not converted any into a Roth, because at my death, all of the money in my IRA goes to this foundation, the Merriman Financial Education Foundation. So it doesn't make any sense for me to convert. But I will tell you, there's so much. The other place to go look right now, I think it's called thebalance.com. They do some super work in that area.
Okay. Yeah, Richard's second question is, have you looked at using the IRS RMD factors as a withdrawal strategy? You know, they tell you how much money to take out every year versus a set percentage adjusted by inflation.
You mean in terms of a recommendation?
Well, or I think he's asking, you know, you could use that in an analysis of how, you know, what your experience would be. You could do a back test with
Are
it.
you trying to apply that RMD to the tables I just presented?
I
As a
think
part
that's
of
what
that?
he's asking.
You know
yeah.
what I've assumed, and this is a problem with trying to educate everybody with the same tables. What I've assumed is that you are taking that percentage out. You are paying taxes out of that percentage. That's not adjusted for taxes, and it is not adjusted for RMDs. Now, having said that, I know we're not going to get Daryl's face on balls here on this chat, but if Daryl Balls wants to take on that project, that would be a great one. But the fact is, there are other people that have done that.
This is Daryl. Can you hear me?
Yeah, we can. Go ahead,
Daryl.
Daryl.
Yeah, I saw that, and using the RMD factors as you age out increases your later returns over what you would have had earlier on. So to a certain extent, it's just an amplification of what Paul already shows in that with the flexible distribution, and that your later distributions become very high relative to your early distributions, and that's fine if that's what you want. The question is whether or not you need to or want to leave anything to your heirs, or leave as much to your heirs, or whether you want to hold that back in for the infamous unknown unknowns that may occur later on in your retirement.
Well, and I think that just because you get a distribution doesn't mean you can't reinvest it after you've paid whatever taxes, if you have taxes on it, at which point, in essence, the table is still valid.
Well, that's true. To me, taxes are an expense, so that's something that gets paid for out of your distribution.
Yep.
Yeah. Okay, let's go to Kenneth Larson had another question. Sorry, is Paul going to talk about the comeback portfolio, or is that the four-fund portfolio?
Yes, the comeback portfolio is the four-fund. And the reason I call it the comeback portfolio is because if you go back and look at those tables later, you will find out that after serious bear markets, that combination comes back stronger than the S&P 500. Now that would be true of small cap value on its own. Some of small cap value's best days are after a major decline, and part of the reason is because the rubber band is stretched way down when that market turns around and starts up, and it pops up very quickly.
Okay, and then Carl asked, in the 50-50 portfolio, what type of bonds are you using?
Those bonds are, Daryl, there you go, by the way. You did all that work. Go ahead, answer that question.
Got it. They are 50% intermediate term treasuries, 30% short-term treasuries, and 20% tips. That's the fixed income side of the portfolio.
All governments. And the reason for the reason for all governments is basically because we're looking for fixed income that is likely to go up in a period of crisis. If you look, for example, at 2008, there was a rush to governments, and because of the quality, and that's the reason we have the bonds there, is not because we're looking for income from the bonds, but because we're looking for stability. I will mention that on our website, under the Vanguard recommendations, we have what we call our monthly income portfolio, that is a different set of bond funds for people who are basically looking for a monthly fixed income check.
I have no idea if people here know how rare this is. This is the first time, Paul, me and Daryl have been together in a conversation live in like over a year. This is awesome. So, okay, Radford Lowe has a long question. Says, we in California have the nation's largest pension system, CalPERS. Its assumed investment earnings rate is 7% plus. Not long ago, their own CIO told his board that over the last 10 to 20 years, the system has fallen short of the 7% mark. Back in 2016, an outside consultant stated that the best average annual return they should expect was 6.2%. Your data, even with the 50-50 stock bond, shows a higher average return. While we don't know CalPERS asset allocation, why do you think the investment teams of the pension funds across the country are missing the mark?
Well, we have to remember, recently there's been a lot of negative information about small cap value and its underperformance. These people, these big pensions, have a lot of the S&P 500 and similar kinds of holdings. Since 2000, the compound rate of return of that index is about 5 to 5.5%. It's been a terrible period overall for equities, and I don't argue. I'm sure if John Bogle were alive today, he would be coming up with about 6.2% himself, because he was not hopeful for high rates of return over in the last years of his life. I recommended that you take 2% off those returns there. The problem is that bonds over that 50-year period compounded at some much higher rate of return. I think it's about a 6.9% compound rate of return. Where are you going to get 6.9? You can't even get that in junk. So when we look backward, at this point in time, it doesn't look like it's highly likely to produce the same kind of returns for the next 50 years. The problem is that when we started that 50-year period, we didn't expect to get the kind of returns that we did. As a matter of fact, as we start that period, most pension funds were still mostly in fixed income. And the reason they were mostly in fixed income is because they were still remembering the pain of what happened in the Depression. And they were never going to put their pensioners at that kind of risk again, because they were living with recency bias. I don't blame them for feeling that way. And we are trying to deal with recency bias, or we are thinking in terms of recency. What we don't know is what's going to happen to interest rates in the coming years. If you print enough money, remember, if you see what we are doing, the motto is, if we need it, we will print it. Okay? It's coming. And there are people who are going to take that money gladly one way or another, and probably a lot of them are going to put it into the market. But we could have inflation in the future. It's possible. People will sometimes, you take all that work that you do, Chris, you've done it all the way back to 1928, looking at the returns, and Daryl has done that. And people will say, wow, why do you go back to 1928? Are you crazy? We're never going to have 1929, 30, 31, 32 again. Guess what? From about 1969 to 1974, the inflation-adjusted return was the same in our market here as it was from 1929 to 1932. We have seen the enemy, and the enemy is us. And those past returns that are bad are just as legitimate today as are higher interest rates legitimate in the future. We're just not there yet, because recently, young people, think what young people think about returns of bonds. How could you ever retire on a 2% or 3% return?
Okay, Paul, I think we've got just a couple more. So Aaron asks, how are these charts changed if you show growth allocations?
Oh, pure growth.
Yeah.
Okay, that's a really great question. And I know that if you look, for example, at small growth going back to 1928, if you look at large growth going back, you will see lower rates of return. Think about the S&P 500. It is half growth and basically half value. Actually, by other people's definition, they're not half value, but by some definitions, they are half value. And what we see, if you look at large value, is about a 1% per year higher rate of return. And the reason it's higher is because you've taken out the growth. So in theory, the growth was about 9, and the value was about 11. The ending result is around 10.
Okay, from Adam, for international large cap blend class, I have developed markets and total international stock market index options in my 403B account. Which one do you and Paul recommend? What is the difference between them?
Well, they're basically the same. If you just told me that one is a developing and the other is a total international, they are virtually the same expected return. It's the same with the total market in the S&P 500. Why do they have the same expected return? And the studies that go back to 1928 confirm that, is because the large companies overwhelm the portfolio return because they're cap weighted. You see, people believe right now, they're in the total market index. They've got small cap. And they'll tell me, hey, I got enough small cap. And I'm saying that there's no evidence that the small cap is enough to make an impact on the portfolio. You need more. Now, how much more you need is up for debate. It doesn't have to be the same as I've decided. It could be going to 20%. In fact, some of your work that you're going to show, Chris, I think will show the implication of just adding 10% pure value. So total market, developing markets, they're about the same.
From Justin, a person considering a portion of retirement funds in their 50s going into 100% stock, 20 to 30, I'm not really sure what that means. Is it still a good way to sell any stock that falls 8% of the purchase price instead of buy and hold?
Really, at age 76, I can't figure that out.
Okay,
I do apologize.
That's okay. We'll go on to the next question. Okay. Sorry, dumb question. Can you please list out mutual fund names for 4-fund portfolio? We'd have those on the website, right?
You can yes, you can go to our homepage and go to ETFs. And what I want you to do is I want you to open that up, and there are articles and there are podcasts as well as the recommendations.
And we have mutual funds or ETFs, right?
Mutual funds or ETFs, by the way, yes. But Chris has actually recommended what we call best-in-class ETFs for all the major asset classes discussed in that larger 10 list, which includes the small cap value and small cap blend, et cetera.
And Tammy actually provided a link in the questions. I didn't get to that till just
great.
Yeah, thanks for that. Okay,
I will say that the values, the numbers that were shown in the charts that Paul showed for the 4-fund combo are just pure asset class returns. They're indexes. They use indexes from DFA. So once you transition to real mutual funds, your returns are likely to be a little bit less than that, and maybe a lot less depending on how pure the asset class the fund is to the asset class.
That's great. Thanks, Carol.
Okay, so David Gardner asks, bond funds versus bond laddering. In these times of very low rates and maybe for the foreseeable future, do you still advocate bond funds over bond laddering? For a bond fund, one would be buying at a high, and if one ever needs to redeem some or part of the funds, then one would be selling at a lower price. At least with bond laddering, one could get their face value back at a later point in time and can stagger the bonds so they mature on an incremental basis. So what do you think?
And I'm totally okay with that. The reason that we use short to intermediate maturities. So you're not holding any long bonds in this particular defensive strategy. And we're looking at using a distribution from the total portfolio, not just taking money from the bonds. We're using a total return way of taking distributions. So there are a number of things that would be an advantage to using the rolling CDs.
All right, and then Dick Duker, I hope I'm saying that right, asks, what about mid-cap funds?
Well, by the way, you're going to get mid-cap in a mutual fund that says they're large cap, and you're going to get mid cap in a lot of the small cap funds. What we're trying to do here is like a dumbbell approach, and we're rebalancing. And what you find is, if you look at the returns over time, that there are periods when small cap is just terrible, big cap is really great, followed by a return that they just reverse. So for rebalancing purposes, you're better to be out at the edges than you are to be in at the middle. But mid cap is fine.
Cool. I think we got to the end.